Ready? It's looking like Sikorsky's not quite ready. So I think we'll start with Sikorsky on number 7, and we'll do number 6 in class. So.
Gerard.
Gerard. Do you go by Jerry or Gerard?
Gerard.
Gerard it is. Okay, number 7. Number 6, right?
Number 6. Cost of the item sold was $27,000.
Okay.
So I am.
Kind of a tricky one.
The assets go down by $27,000.
Assets go down. That's the first. What's that asset called?
Probably cash.
No. What did we say?
Inventory.
Inventory. That's right. So an asset went down by $27,000. Now, how do you get your accounting equation to balance?
Well, it's going to be one of the 3.
Good start.
I'm not sure.
It's a little bit tricky.
I mean, from the previous one, it was rolled into retained earnings. That was the sale.
There was a clue. That's right.
I mean, it's an expense which is rolled into net income.
Is that your final answer?
Yes. Retained earnings. Yes, it is my final answer. I guess it's an expense which is rolled into net income, which is rolled into.
It's an expense called cost of goods sold, and an expense is what type of an account? An equity account. Right. Now, is it an increase or decrease in an equity account?
It's going to be a decrease.
It has to be a decrease, and this is the thing that's a little bit confusing. Okay, it's a decrease in an equity account for $27,000, and the confusing part is what? What happened to the amount of that expense? Did it go up or go down? The expense actually went up, right? But equities in total went down. And so this negative sign is representing the effect on equities in total. But now the question becomes why? Why did equity go down by $27,000? Does that make sense, everybody? Why did equity go down? Don't everybody jump up at once. Why did equity go down?
In some ways, you had to pay either another company to produce it for you, or you had to pay your internal employees to do it.
Right. Retained earnings is what? Revenue minus expense, which is net income. The equity count is retained earnings. But notice what happens. When the expense goes up, net income does what?
Down.
Goes down. Yeah. When the income goes down, what happens to retained earnings? Goes down. What happens to the equity accounts in total? Goes down. Does that make sense, everybody?
Can you do that again?
Let's do that again. All right? Now, what are we doing in this example? We're recognizing an expense, and that expense is called cost of goods sold. Now remember, the two questions we're trying to answer every time we do this. The first is, what type of an account is it? The second question is, how did it change? But the first question, right, hopefully everyone has a little bit of intuition of what the assets are. Cash, receivables, property, equipment, things like that. Every liability that we deal with is going to be blah, 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 payable. Right? So anytime we see a payable at the end, that means it's a liability account. And so the tricky accounts at the beginning are really the equity accounts. Now, understanding how the equity accounts affect the accounting equation turns out to be, a little bit tricky, but it's not that bad, because we really have revenue accounts, and revenue accounts would, again, go back to our income statement. An increase in a revenue count, ignoring everything else, is going to increase net income, which is going to increase retained earnings, which is going to increase equities in total. On the other hand, an expense account, which is this example right here, cost of goods sold, we're recognizing the expense because we're reducing the asset, right? That expense, the amount of the expense went from 0 to 27, so it actually increased, but recognizing that expense caused a decrease in net income, which caused a decrease in retained earnings, which caused a decrease in equity accounts in total. So when we go back to the accounting equation, the key thing to understand is these negative signs or positive signs or whatever, they're not indicative of what happens to that. They're indicative of what happens to the accounting equation, and that's the key thing to remember. That whether it went up or went down, it's not whether the account went up or went down, but it's whether the amount, the equity, or the liability went up or went down. So in this case, even though the expense account went from some zero amount to some positive amount, the net effect of that on equity is a decrease of $27,000 because net income would have gone down. Did that help? Questions about that?
Cost of goods sold is always going to be an expense account.
Cost of goods sold is always going to be an expense account, and in fact, that's the only expense account that I'm going to suggest that when you record these things, no matter what the expense is, salary expense, wage expense, miscellaneous expense, interest expense. You always use the term expense so you know exactly what type of an account it is. Conversely, sales revenue, interest revenue. If it's a revenue, if it's cash coming in, we attach the term revenue to it, but we describe it better than just revenue. And that way we are practicing understanding exactly what type of an account all these things are. Now, after you've done this for a week or two, it's going to be second nature, right? It's going to be obvious. But right now, it's not so obvious, and you have to kind of force yourself to get into the habit. And so the question is always, what type of an account is it? Did it go up or go down? And what effect does that have on the accounting equation? Those are the questions we're asking every time we record something at the beginning of this class. Questions? Sikorsky, number 7. Come online, please. Who gets number 1? Who gets number 7?
Subtract $43,000 for cash.
So cash was down by 43, if I heard you right.
And accounts payable. Yep.
Who's talking?
Accounts payable. I am.
What's your name?
Dean Fabrizio.
Dean, nice to meet you. Okay. So asset cash goes down by 43, and what else happens?
43,000 goes down in liability and accounts payable.
So accounts payable goes down by 43. And so this transaction is that assets go down and liabilities go down. Questions, anybody? Okay, number 8. Dean, who's sitting to your left?
Mary.
Mary, you're on the docket.
Okay. Number 8, right?
Number 8.
Receive 47,000 on account. So that's accounts receivable. That would be a plus on the asset.
Okay, what's that asset called?
Accounts receivable.
Now, what did we get?
Cash of $47,000.
Right, so the asset account cash goes up by 47,000, agreed. How do you balance your accounting equation?
On the same account. Okay, and then we would decrease accounts receivable by the same amount.
Right, so they owed us the money, it was an asset to us. When they pay us, they no longer owe us. We decrease an asset account called accounts receivable for 47,000. Questions? Okay, Mary, who's on the end in what looks like a striped shirt to your left?
Hi, Professor. David Stendhal.
Oh, no, not you, Dave.
Thanks a lot.
Number 9, Dave.
We're going to pay $11,000.
Okay, so what are we going to pay him with?
Cash.
Cash.
Deal with that assets.
Asset goes down for 11,000, right? The asset cash
Right.
goes down for 11. How does your accounting equation balance?
Well, we got to balance it by taking 11 off of earning, equity.
Equity, right? So we're going to recognize an expense account called what?
Salary.
Salary expense, wage expense. Again, I don't care what you call it. The important thing is to recognize it's a decrease in an equity account. So we're going to decrease the equity, decrease that equity account by 11,000. Questions?
When you see the term on account, how did you know that meant accounts receivable? Or how did you know that meant cash? For number 8.
Wait, we receive 47,000 on account. Usually on account is going to reference, if we owe somebody, it's going to reference accounts payable. If somebody owes us, it's going to reference accounts receivable. So on account is kind of an amorphous term, usually referencing either accounts payable or accounts receivable. So if
How do you know it's not cash? Like in number 5, it said we received 52,000 was on account, and we said that was an asset and that was an account receivable.
Right.
And number 8,
you have to get used to terminology. It just takes practice.
So on account sometimes means cash, sometimes means account receivable.
Well, again, if we're paying something on account, that means we're paying down accounts payable. If we're receiving something on account, it means we're receiving cash, but we're reducing accounts receivable. It just takes practice. So this on account thing, you just have to kind of practice it a few times to understand what's going on. Questions? This question over here. What's your name?
My name's Chris.
Chris, go ahead.
So why is it a liability if you're paying them?
Well, if we pay them, do we owe them anything?
No.
Okay. A liability is what?
When you owe them.
When you owe them. So if we pay them, we don't owe them.
Right. So
So it wouldn't be a liability.
Okay.
Okay. Now, if we agree to pay them, we're not going to pay them until next week. Then between now and then, it would be a liability.
Okay.
Right? Because we owe them the money, we're not going to pay them for a while.
Okay.
In this case, we're paying them. Number 10. Lonnie, you want to do number 10?
Sure. Pay 3,300 for various operating expenses. That would be a negative 3,300 as an asset.
What's that asset called?
Cash.
Cash.
And it would be a negative in the equity.
Okay, it's an expense account. What are you going to call that expense?
Operating expense.
Operating expense. Sounds good to me. Miscellaneous expense. Doesn't matter to me what you call it. 11. Question?
Yeah. How do you know that you have enough cash to cover that? Like, because as we're going now, we're not keeping track of like totals for each column. So how do you know that you have enough cash to cover these expenses?
Would you go to the oh my gosh, computer. Would you go to the computer, Brad, real quickly? It turns out we do keep track of these things, right? So what's happening is that the firm is keeping track of their cash account assiduously. Every time they write something out, they know exactly what they have in their cash. Just like you, keeping track of your cash balances, right? You would reconcile your cash account. Firms do it on a daily basis. Because what they're trying to do is trying to minimize the amount in their cash account and maximize the amount in some interest-bearing account. So they assiduously manage their cash account to keep as little in there in a non-performing, right? They want to earn interest on everything they can. So they manage that account extremely closely. Does that answer that question? Okay. So if you come back to the class piece. Now notice what I brought up on the computer screen. Let's go to that real quickly. In your notes on page 12, all right? Just so you know that you have what I just showed you. On page 12 is a spreadsheet where we list all the transactions in a nice big summary form. All right? I'm going to ask you to come back off of 12 because we have a couple more things we want to do. but I just wanted you to see that, in fact, the whole thing is basically spreadsheeted out for you in the notes, and you can go back and look at everything we did and get a good summary of everything in this spreadsheet. Okay. So we're at number 11, right? Number 11, please. Park. Okay.
Pay 3,000 for federal income taxes.
Right.
Minus 3,000 for assets.
Cash goes out the door for 3,000. Agreed.
Cash.
Right. And you're
Minus 3,000 for equity.
3,000 decrease in equity. What are you going to call that equity account?
Pay tax.
Tax expense. I mean, you're certainly the right idea. But again, the terminology seems to have to be important at the beginning because you want to label everything so you know exactly what it was. For instance, if he just labeled it taxes, right? It could be at the end of the year we owe the government some money, in addition to what we already paid, right? And we could call that taxes as well. Except for now you wouldn't understand which tax was the amount we already paid, which tax was the amount we owed. So if you label the first one tax expense, that's an expense, something we already paid. The other one, taxes payable, down the road, that means that we would then owe the government the money, and it would be a liability. Now, again, the terminology at the beginning turns out to be important because we want to be very precise in how we're recording this information. Questions? All right. The adjustments. The first adjustment is depreciation. So we go down below B where it says adjustments. Equipment is depreciated over 10 years using the straight line method.
A question about the taxes.
Sure.
How would you record a tax payable? You know you have to pay the taxes, so they're always tax payable until you pay them.
Okay, so the question is, how would you record a tax payable? And that's a good question. So if let's say we were going to owe another $400 in taxes, right? And at the end of the year we make an adjustment, recognizing that we owe the government some money. Okay? Then what we would do is we'd recognize another expense for $400, and we'd call that income tax expense, just like the last part was, and we'd increase a liability for $400 because we owe the government the money, called taxes payable for $400. Right? So in this example, this entry would recognize more expense because we owe the government the money. At the same, or we would recognize expense because we incurred that expense during the year, and yet the $400 means we owe the government the money, and we haven't paid them yet. Does that answer your question? Okay. So let's talk about depreciation. The basic idea behind depreciation, very simple idea. All we do is we prorate the cost of the asset over its estimated life. In this case, we buy an asset. What was that asset worth again? Worth $25,000. That was your asset, right, Armin? Okay. You want to do depreciation for us? No, he says. Okay. So the asset has a cost of $25,000. We're going to depreciate it over how many years? 10 years. And therefore, depreciation expense is going to be $2,500 per year. Does that make sense to everybody? So we go to record this. Again, the amount is $2,500, right? Keep that up there. We go to record that $2,500, and we have assets equal liabilities plus equity. We record that $2,500. Where are we now? Next part. What's your name? Mike?
Yeah. Okay.
The first question: does cash change when we make this adjustment?
I don't think so.
The answer is no. Anytime we make an adjustment, adjustments have no impact on cash. It's the first thing to keep in mind. Transactions may or may not affect cash. Many of them do. But the adjustments happen after year end. And the adjustments never, ever have an impact on cash. Okay. So what we're doing here is we're recognizing what?
We're looking at where depreciation.
Okay, depreciation.
And I'd say it's assets.
Okay, assets is what?
decrease.
Okay, what's that asset called?
Your equipment.
Equipment, right? By how much?
25.
2,500. So the asset equipment goes down by 2,500. Okay. And your equation doesn't balance.
Right. So we need to take 2,500 off equity.
Okay, we reduce an equity. It's an expense account. What are you going to call that expense?
Depreciation.
Depreciation expense.
Expense.
Right. So depreciation expense for 2,500. Questions about that? Any of that? Thank you. Okay. This was A. B. The value of the remaining insurance as of the end of the year is $500. Who bought the insurance? Okay. How much insurance did you buy again?
$2,000.
Okay, there you go, Renee. $2,000. How much did you use up?
$1,500.
$1,500. What's your entry going to be? Now, when we bought the insurance, let's go back. When we bought the insurance, it's gone. What was our entry?
It was prepaid insurance.
We created an asset called prepaid insurance.
For $2,000.
And after the end of the year, the balance in that asset now is how much?
$500.
$500. Right? So we have to recognize an expense for
$500.
$1,500. Right? From $2,000 down to $500. So how are you going to do that? What happens to prepaid insurance?
It goes down.
What type of an account is that?
Oh, that's an asset.
Okay, so an asset goes down by $1,500. Prepaid insurance goes from $2,000 down to $500. How does your accounting equation balance? Not yet.
On the equity side,
Okay.
insurance expense.
Insurance expense for $1,500. Does that make sense to everybody?
So you bought this insurance at the beginning of the year, and now it's
When did we buy the insurance?
in April.
April what?
April 1st, wasn't it?
Good day to buy insurance.
April Fool's Day.
April Fool's Day.
So by April 1st of the next year, it'll be zero.
Correct. It will have used up, the $500 will have used up its value as of March 31st. Right. But then we have to buy more insurance on April 1st next year.
The number 500 is really just 3/4.
That's all it is. And so basically all we would do is we would prorate the amount of insurance on either a monthly basis or a daily basis or something along those lines. In this case, 3/4 of the year, 3/4 of the insurance. Right? We prorated the $2,000. Questions? Okay, last one. Now's a good time.
On the insurance, when we did it up there, I don't remember exactly what we had. Did we subtract 2,000 from the assets?
Yes, we did it both in the same column.
Yes.
Oh,
We
we
paid
did minus
cash.
2,000 and plus 2,000.
Yes,
And
we recognized an
okay.
asset called prepaid insurance and we reduced the asset cash.
Okay.
Okay.
Thanks.
My pleasure. C. Where are we? Okay, who are you? Terry. So we owe employees $700 for their services as of year end.
Asset. Cash would be.
Wait a second. Did we pay them?
Here.
Here, let me describe what went on. It's a little bit confusing. So what went on here is, I don't know if this happens where you work, Tara, but what often happens is people work toward the end of the year. This is 12/31, but they don't actually get paid until the next year, right? So what we just saw was a situation where people work and we owe them the money to the tune of $700, right? But we're not actually going to pay them until the next year. And so we're going to recognize an account payable, a liability. That's right. So we go back up here. We recognize a liability for how much? 700. Now, Tara, your equation doesn't balance. You're right as rain so far, though. How do we get this thing to balance? It's an equity. It's an expense account. You're exactly right. Right. So all we're doing is we're recognizing a little bit more expense, a little bit more salary expense We already paid our employees a certain amount of money. How much did we pay them already? Just think about what we've already done, right? It was 11? I think we already paid them $11,000 previously, and now we're recognizing that we owe them an additional $700. So what will salary expense be for the year? Likely $11,700. Right? So all we do is we add it up. Does that make sense there? Okay. So okay. Here we decrease the equity account for $700, and that would be salary expense. Questions? Okay. Now we go back. Let's go back and revisit. What was it we were trying to do again? What's the whole point of this exercise? Right? We recorded transactions during the year. And that was what? 1 through 11. Then at the end of the year, we recorded adjustments. And that was A through C. And then once we record the adjustments, we summarize. And that is page 12. Right? And page 12, if you will come to the computer screen, please, Brad. Now, on your page 12, all I show right here on the computer screen are the assets. Right? So, if on page 12 you'll go down the cash column, what we see is we started out, let's kind of remember what went on, right? The $60,000 was when we started the firm. People put in money as common stock. Then we bought we paid $10,000 for some of the equipment. And then we paid for some insurance, $2,000. Then we received money when we sold some goods, and then all the way down. At the end of the year, what's the ending balance in cash? Bottom row, right? $43,700. Let's go. Accounts receivable. We made the sale initially. We had $52,000 as a receivable. How much of that came in cash? 47. 52 minus 47 means the amount that's owed us at the end of the year is $5,000. This is making sense. Again, very simple system. It's a it's a third grade arithmetic problem, right? Inventory. We bought $35,000 in inventory. We sold 27. What do we have left? 8. Right? This is very easy stuff. In all honesty, accounting is a very, very easy process. Once you understand what type of an account it is, all you're doing is adding things up. It's a very, very simple process. On the equity side, go to the accounts payable. We recognized $15,000 when we bought the equipment, $35,000 when we bought the inventory. Subsequent to that total $15,000 would be $50,000, right? Subsequent to that, we paid off $43,000. Part of it to the equipment manager, part of it to the inventory people. And therefore, we owe at the end of the year how much? $7,000. Wages payable, capital stock. The last column is the retained earnings column. And the last column lists all of the various revenues, right? The sales revenue is 61, plus all of the expenses. And notice the net down here. The net's going to be $12,000. So what will retained earnings be for the end of the year? $12,000. What's net income as of the end of the year? $12,000. Right? This is the first year of operation. Hence, the first year's net income is going to be the first year's retained earnings, providing they didn't pay any dividends. And in this case, we have no record of any dividends. Hence, in this simple case, the net income would then be equal to retained earnings. Does that make sense to everybody? Okay. Go to page 12. Let's take a look at the actual statements. So page 12, page 13. Top of page 13. Notice the balance sheet. Total assets equal what? $79,700. Total liabilities and equity, total what? Notice the balance sheet balances. Accountants get a warm, fuzzy feeling when that happens, okay? That makes us feel really good about what we've done. The balance sheet balances. That's a very good thing. Now, you laugh about what I just said, and you understand how to do it, I think, but I'm willing to bet right now that the project that everyone hands in, of the 30 people in the room right now, someone's going to hand in a project, and they're going to hand me in a balance sheet that does what? That doesn't balance. Who wants to bet on that right now? I've never had a class that everyone got the balance sheet to balance. And I've done this 25 or 30 times in many different classes. Someone always forgets something and doesn't check over it, and the balance sheet doesn't balance. And I hand it back to them, and I say, try again. So, for now, look at the form of the balance sheet, right? So on the assets side, I have the assets on the screen. So the assets, notice, again, the assets are listed in order of liquidity. And we have cash, cash receivable, inventory, prepaid insurance, total current assets. What we will often do is we will separate out current assets from long-term or non-current assets. What's the demarcation line? In other words, what separates a current asset from a non-current asset? 1 year or less. If we expect that thing to produce cash in 1 year or less, the receivables, the inventory, prepaid insurance, then it's a current asset. If we know it's going to last for more than 1 year, equipment, buildings, land, things like that, then it's a non-current asset. We categorize it separately. Similarly, on the liability side, current assets are, or current liabilities are liabilities we expect to pay within what? Within 1 year, right? Within one accounting cycle, which is usually 1 year. And accounts payable, wages payable. In this case, we do not have any long-term liabilities, but we have equity accounts. Capital stock, retained earnings. Notice the retained earnings, $12,000 equal to this year's net income, right? Because we had a zero beginning balance and because we did not pay dividends. Hence, this year's retained earnings is 12, giving us total liabilities and equity $79,700. Last thing, we take a look at the income statement. Notice the form of the income statement. The form sales comes first. Now, usually what we do is we put sales less cost of goods sold, and what that gives us then is a thing called gross profit. So this is especially important for manufacturing concerns, right? So it would be the amount of the sale less the cost to produce the goods gives us gross profit. And then after we get gross profit, we then subtract out all of our operating expenses. In this case, wages, depreciation, blah, blah, blah. And it comes down to a thing called income before taxes, or sometimes called earnings before taxes, or EBT, which you're going to hear more of in this class. It's a very important demarcation line. So the earnings before taxes in this case are $15,000 less income tax expense of 3 gives us net income of 12. Right? Questions about that? Okay. Page 14. I am about to complicate your life. And you're not going to like this at all. Because what we just did to create the first income statement, turns out, is not the way accountants do business. It is not how accountants talk to each other. Accountants talk to each other in terms called debits and credits. Now, if you've had accounting in the past, this should not strike dread into your hearts, because it's a very simple idea. And what we're going to do is we're going to use the framework that we just created to be able to translate what we already understand, which is how to record the information, and we're going to use that to then understand how accountants actually communicate this information in terms of debits and credits. So, go back to the accounting equation. Assets equal liabilities plus equity accounts. Now I'm going to use a thing called T accounts to describe what's going on. So I have a T account for assets, a T account for liabilities, and a T account for equity accounts. Anyone know what we call them T accounts? So, on the left-hand side of any T account, if we left this thing, it's known as debiting the thing. In this case, we're debiting an asset. So, debit's always on the left. And we use DR for debit, for a reason I have no idea. And if we write it, we credit it. So debits are always on the left, credits are always on the right. Now, for assets, if we debit it, we increase it. If we credit it, we decrease it. Right? Now, once we flip it to the other side of the equal sign, what has to happen over here? If we debit something on the other side of the equal sign, we have to do what? We're going to reduce it. If we credit it, we're going to increase it. Similarly over here with equity accounts, if we debit it, we reduce it. If we credit it, we increase it. Now, the way accountants actually write journal entries looks like this. We list the debits first, and then we indent and put in our credits. So if we go back to journal entry number 1, and journal entry number 1 was what? The firm sold common stock and received $60,000 in cash, right? So if we record that in terms of our debits and credits, what's happening is we are debiting, increasing an asset, called what? Called cash. For how much? $60,000. And this is going to be a debit column. This is a credit column over here. And does not relate to our T accounts above. It's just separate columns. And the firm recognized what? An increase in an equity account called common stock. So we go over here. We recognize an increase. We credit. Therefore, we indent in. So we credit, we write it, right? It's on the right-hand side. We recognize an increase in an equity account called common stock for $60,000. And notice that we move the entry to the right relative to debits. So we have a debit column. We have a credit column. We debit, increase an asset called cash, here for $60,000. We credit, increase an equity account called common stock for $60,000. Now the way accountants would actually write that journal entry looks like this. But we recorded it what? Up here, we simply said, well, cash went up by $60,000. We increased assets by 60, and we increased equity by 60. Now, the way we recorded it is exactly the same information as the way the accountant would record it down here. Because all we did was what? Right? On the equity account, we increased, we credited an equity account for $60,000. The asset account, we debited, we increased an asset account for $60,000. So the terminology we use translates directly into the debits and credits. Questions about that? Now, the only way to figure this crap out is to practice. And so practice we're going to for the next few minutes. If you go a few pages forward, go to page 16. On page 16 we have year 2. So our goal in year 2 is the same as our goal from year 1, right? Which is what? Create an income statement and a balance sheet for year 2. Except for the complication, and this is what's going to take practice on your part, right? The complication is now, instead of just doing the accounting equation, now we're going to be talking about it in terms of debits and credits. But my suggestion is to always use the accounting equation that we've developed, primarily because it's so simple, to help us understand debits and credits. Questions about that? Okay. And another thing to keep in mind is, if we go back to those, if we go back to the computer for me, Brad. Now we go down here. The ending balance in cash last year was how much? $43,700. What's the beginning balance in cash this year? $43,700, right? So this balance was last year's ending and this year's beginning balance. So if we start writing checks, we subtract it from 43,700, excuse me. Similarly, we already have, people owe us $5,000, so we move that forward. So all of our balance sheet accounts have beginning balances, right? Cash is the beginning balance of 43,700, receivables 5,000, inventory we have 8,000 already hanging around before we buy more. Prepaid insurance we have 5,000, that's going to wear out as of April Fool's Day. But again, we have all these. On the liability side, we still owe $7,000 in accounts payable. We owe $700 to our employees in the second year. $60,000 was the amount of cash, and retained earnings netted out of 12. So from a retained earnings perspective, for the second year, the beginning balance starts at what? At $12,000. Then we add in this year's net income, subtract out this year's dividends declared to give us this year's ending balance in retained earnings. Right? Say that again. Again, in terms of the spreadsheet, the beginning balance in cash is going to be $12,000. To that, we're going to add the second year's net income, subtract out dividends declared in the second year, and that will then give us the ending balance in retained earnings for the second year. Questions? Okay. If you come back to the sheet here. So we are on page 16. And Terry, I abused you last, right? Chris, have I, you've had a chance to make a mistake here yet, have you?
No,
No? Okay. Well, here's your chance.
Right. So number one is purchase inventory for $40,000. Agree to set balance in 30 days.
Great.
So I'm assuming you're going to debit your assets for $40,000.
Okay, so we're going to debit. We're going to increase an asset called what?
Inventory.
Inventory. For how much?
$40,000.
$40,000. We're going to credit what?
And you're going to credit your liability.
Okay, what type of account is that? Is it an increase or decrease, I guess?
It's a decrease.
Excuse me?
Credit decrease.
Increase the liability account, credit the liability for our key accounts in here, just to keep sure. So, debit's on the left, credit's on the right. Oops, screwed that one up. Just kidding. So we credit a liability account called what?
We credit a liability account called, with the inventory also, or accounts payable?
Accounts payable.
Okay.
Because we owe someone the money. We haven't paid them yet, we owe them the money. So in terms of the accounting equation, right, so this is what the journal entry would look like in terms of debits and credits. In terms of the accounting equation, it would look like what? We increase an asset over here by $40,000. An asset is called what? Inventory. And we recognize an increase in a liability called what? Accounts payable. And our accounting equation balances. Does that make sense, everybody? Questions? Now, if debits and credits don't make total sense just quite yet, you're not alone, right? And that's why we're going to go through a couple examples, and whoever I call on next, who's just to Chris's left here, who just woke up or became very bright-eyed, I guess would be a better way to put that. If you don't get it, that's okay, because I'll help you through it. Right? Now, I need to create my cheat sheet up here. So this is our cheat sheet. And now we're doing number 2. And it's Jessica?
Yes.
Okay, Jess.
Paid $2,200 for insurance policy on 1 of April, and the policy has a 1-year term.
Okay.
So I would say debit the asset for insurance,
Okay.
$2,200.
Debit, increase in asset, prepaid insurance, the $2,200, right?
Right.
This is debit, this is credit over here.
But then we do credit cash as an asset.
Credit, decrease cash, decrease in asset cash for $2,200. Right? You comfortable with that?
Yes.
Didn't need my help at all, did you? Here I was going to be your knight in shining armor. Didn't even need me. So in terms of the accounting equation, like we were doing first half of the class, we're increasing an asset of $2,200. That asset's called what? Prepaid insurance. We're decreasing an asset of $2,200. That asset's called what? Cash. Questions? Okay. Certainly
It's an
can.
annual policy, and we're taking it out in April.
April 1st, right.
It's going to be like 3/4 of the year.
That's right. We're going to have to prorate the amount we bought.
At that point. Right now, we don't do anything with the entries at that point.
That's right. We'll make an adjustment at the end of the year.
That's right.
That's right. So we need to make an adjustment at the end of the year to record the appropriate amount of insurance expense. And the insurance expense is going to be what? The $500 that we used up plus 3/4 of the amount we just bought. Okay, just who's here left? Think. Art. Okay, Art.
Okay, sales total $73,000, $11,000 was received in cash, and $62,000 was on account. I guess we would credit our assets, $73,000. Or
okay, what asset in particular
that would
went
be
down?
I think here. Oh, sales, that would be equity then.
It'd be an equity account. That's right. Now,
Sales expense.
did we increase or decrease the equity?
That would be an increase.
It'd be an increase, right? So it's going to be a debit or a credit?
Be credit.
Credit. So we're going to usually put the debits first, credits second.
Okay.
So I'm going to leave some space for the debits. I'll put the credit in. We're going to increase an equity account. It's a retained earnings type account. I'm just going to put that in to remind us. And we're going to call that sales or sales revenue. Or just sales would be fine as long as we know exactly what we're talking about. For how much?
That was $73,000.
$73,000. Okay, and this is a credit, and we have debits over here. Okay.
And then our assets was debited $11,000.
Okay, we debit an asset account. We debit or increase an asset account called what?
Cash.
For how much?
$11,000.
Okay. Doesn't balance yet.
And then also that's for. This I'm not sure. Would it be credit or liability?
No. Again, well, what's happening? We're selling someone, and they're saying, we're not going to pay you now, we're going to pay you later.
$62,000 for a debit, but just it's.
Well, again, in order to get this in the balance.
Accounts payable. Accounts receivable, excuse me.
Okay, make up your mind.
Accounts receivable.
Okay, accounts receivable. What type of account is that?
Accounts receivable, I mean,
An asset liability equity account.
It would be, I guess, asset.
An asset account. So we increase an asset account called accounts receivable. For how much?
And that was $62,000.
$62,000. Now, notice what's going on. Let's put in what we would put in at the beginning, first half of the class. So what we have here is an asset cash increases by $11,000, right here. An asset accounts receivable goes up by $62,000, right here, and an equity account increases by $73,000. So what's going on here is saying that the accounting equation has to balance. This is all this stuff up here. Means exactly the same as debits must be equal to credits. So another way to say assets equal liabilities plus equity is simply to say debits are equal to credits. And so what's happening is every time we make a journal entry, right, we total this up, 73, we total this up, 73. It has to be the case that all the debits total to all the credits. Does that make sense to everybody? So what's going on in mathematical terms is the accounting equation is simply a linear transformation of debits and credits. It's a very simple transformation. Questions about that? Okay.
Why do they call an increase in cash asset like a debit? Seems like it should be the other way.
Well, one of the things that you have to understand about accounting is that debits and credits have very particular and precise meaning. And debit simply means you're lefting it. And that's the best way to think about it. Think about it in terms of T accounts. You're lefting it or you're writing it. Now, so the accounting terminology has specific meaning only in accounting. If you're talking to your banker, and your banker says, "Oh, we credited your account," right? What does that mean? Well, it means nothing in accounting, okay? And that's the first thing you have to understand. That the use of that word outside of the accounting world with bankers, with whoever, is very different than what it means in accounting. And so, in accounting, a debit is simply a left. A credit is a right. And we could stop using debits and credits and start using lefts and rights. And we'd still have the same linear transformation. It just happens that debits and credits have meaning elsewhere that can make this a little bit confusing. But if you simply think about it in terms of the T accounts in the accounting equation, the debit's a left, credit's a right, and that's all there is to it. And you do it, a couple times between now and when you come back to class. You're not going to have to think about it. It's going to be like riding a bike. It's hard to get on a bike and ride it, but once you figure it out, you never forget. It's very easy.
I have a question about the 73,000. That's all of it was under the E column, and then I would think that it would be that minus the cost, because that would be your revenue.
Well, the cost is coming up next.
Yeah.
You're putting all of it right now, it's just that we're all...
Right, we record the revenues first, we record the expenses second. Just to separate out, there's really two transactions. One is the fact that we sold something, the second is the fact that inventory is going out the door. So on number 4, now we're going to recognize the fact that inventory went out the door. Okay, so all we're doing, now you could do that together, but that tends to be a little bit confusing at the beginning, right? Come the middle of February, you want to combine those entries together, no problem. For now, we're separating them out just so we can isolate the fact that there are, in fact, 2 transactions going on. Okay, Art, who sits to your left?
Mike.
About Mike, on to the next one.
Okay, the cost of the item sold was $36,000. So you're going to lose some assets there. So you're going to credit your assets $36,000.
Okay, credit what account in particular?
Assets.
Okay, we're reducing an asset. What asset is it called?
Cash. Or inventory.
Inventory. Right. For how much?
For $36,000.
And what's the debit to that?
You're going to debit your equity.
Reduce, right? Debit, reduce an equity account called what? It's a retained earnings account called
sales.
Cost of goods sold.
That was
good. Good job. Good job. Cost of goods sold. Now, I'll give you people some grief, but the bottom line is there's a lot of new terminology in the first class of accounting. And I know there's a lot of new terminology, and the best way is to have fun with it. But that's why you have an accounting textbook. That first chapter, if you've never done this stuff before, that first chapter might be worth reading. Because the terminology is something we're going to be using every class. Right? And the terminology is based on those 2 simple questions. First one, what type of an account is it? It's either an asset, a liability, or an equity account. And you have to know what those are. right? And so what we're doing in this class is we're creating some signals to ourselves so that we always know, is it an asset, a liability, or an equity account? And the signals are these. Assets account, pretty much we should have some intuition about that. Liability accounts always have the word payable attached to it. Salary payable, mortgage payable, bond payable, always a payable. Therefore it's a liability. We go to the equity accounts. You know what common stock is, retained earnings, kind of what that is. The confusing part is the income statement type accounts. All the revenue accounts, sales revenue, interest revenue, rental revenue. Therefore, we know what the revenue accounts are because we're labeling as such. All the expense accounts, miscellaneous expense, interest expense. We're labeling them as expense. Therefore, we know what they are. And the only expense account that, in general, doesn't get labeled as an expense is what?
Cost of
goods sold. That's right. Cost of goods sold. Questions? Okay, 5? Please?
Jalen.
Say it again?
Jalen.
Shaolin?
Jalen.
Shaolin. J.
Jalen.
J-I-A-W. Spell it for me?
J-I-A-W.
Shaolin.
Jalen.
Okay.
And 5 is pay $44,000 on account. So we should credit cash assets.
Okay, so we're going to credit an asset called what?
Cash assets. $44,000.
Okay.
And debit liability. Account payable.
Debit, reduce a liability account.
Liability. $44,000.
Accounts payable for $44,000. Questions? Okay. Let's see. Let's skip number 6. Go to number 7. Delcy, would you want to try number 7? Okay.
Pay $14,700 to employees.
Delcy. How do you spell Delcy?
D-E-L-C-Y.
Interesting name. Where did the name come from?
Dolores and Cynthia put together.
So his father was named Dolores?
D-E-L from Dolores, C-Y from Cynthia.
Okay.
Pay $14,700 to employees. So that's a salary expense.
Before we go any further, the tricky part here is going to be what? That $700 really is a carryover from last year. Remember last year at the end, we recognized that we owed them the money, but we hadn't paid them yet.
Mm-hmm.
Okay? So that's going to be the tricky part to this particular entry. So we pay $14,700, but $700 of it really applies to what?
Year 1.
What would happen in year 1? And that's what's tricky. That's exactly right. Okay, go ahead.
So does that mean that it's only $14,000 now that's a salary expense?
That's exactly right. So we debit or decrease an equity account or retained earnings type account, salary expense for $14,000. And that is our debit column, or the credit column over here, right?
Okay.
Okay. How much cash went out the door?
$14,000.
How much?
Oh, $14,700.
$14,700. So we asset account, we credit or decrease. We decrease a cash account. We decrease an asset. It's getting late for me as well. Yeah, I just want you to know I'm getting a little tired here. We credit an asset account called cash for $14,700. Okay. Your entry doesn't balance, Dolores, Cynthia.
It's because you had that $700 carryover. From
We have a $700 carryover, right. And in order to get to see the balance, is it a debit or a credit?
It's debit.
It has to be a debit, so let's put it as a debit, right? And what are we going to call that debit?
salary expense?
No. When did we record the expense?
The previous year.
And when we recorded the previous year, we said we debit salary expense and we credit the fact that we owe our employees the money, right?
So it's an account payable.
Well, yes, it was a liability account, except we called it salary payable, I think. We could have called it accounts payable, so you're exactly right. So here, we're going to reduce a liability account, and now we have to go back and make sure we know what we called it, whatever we called it last year, because that's the account we have to zero out. And I think we called it salary payable. But whatever we called is what we needed to go out. So it's called salary payable for $700. Questions? Jesse, you'll account.
No, I'm fine.
Oh, okay. Sure. Questions?
So wait, if we started this year with carryovers from the year before, when we started this entire exercise, why didn't we have already an income?
In year one?
Yes.
Because in year one, it was year one.
No, I mean, now that we're starting year two.
Okay, in year two.
We carried over from year one.
See, she's asking a very good question here. And ask that question again for us, please.
If we're starting year two,
right,
carryovers of numbers from year one.
That's right.
Shouldn't we have started already with cash in our account?
Okay. Well, I think what she's asking is, what do we have in our salary expense account at the beginning of the year? In other words, we're carrying some accounts over. If we go back to our spreadsheet, right, and we go down here, the cash account at the end of last year was $43,700. Therefore, the beginning balance this year is $43,700. And we have a beginning balance in receivable, inventory, prepaid insurance, equipment. All these things have a beginning and ending balance. But now, as I understand it, Darcy's question is, well, what about all these expense accounts and these revenue accounts that we had last year? What's going on with them? Right? And that's a very good question. And here's what's going on. The first thing you have to understand is, what does an income statement measure? What does a balance sheet measure? And what an income statement measures is a flow. Brad. Thank you. An income statement measures a flow across time, whereas a balance sheet measures the amount at one particular point in time. And that particular point in time is what? 12 o'clock midnight on 12/31, right? Now, the best way I can think of to explain this is, suppose we were having a party and we were about to drink a keg of beer, right? Now, here we have some spout on this keg of beer, and we're getting a little tipsy, that's right. And how many quarts are there in a keg of beer? Come on, all you drinkers with the big straw. 60, I think it's 64, right? So the amount we would have at the beginning of the party was 64,000. Now suppose 2 hours later we have 20 quarts left, right? And so the balance sheet at the beginning would indicate that we had 64 quarts at the beginning. The balance sheet at the end would indicate that we had 20 quarts remaining, but the income statement would show what? The flow during the period of 44 quarts, right? And so that's what's going on with the income statement and balance sheet. The income statement tells us the flow between periods. The balance sheet tells us how much we had at the beginning. If you go back to our, go back to the computer for a second, Brad. Right, the balance sheet shows us what we have at the beginning, the 43.7, right? But the income statement shows us the flow across time. Now, it turns out that if we're measuring a flow across time, and that time is from 1/1 to 12/31, if we're measuring the flow across this particular time, and we don't want anything from back there, then the beginning balance in these revenue accounts, these expense accounts, has to be what? Has to be 0. That's right. So the beginning balance in all income statement type accounts has to be 0, and that's the only way we can measure the flow for this particular year. Now, another way to say that is that all of those expense accounts, and again, if you go back to the computer for a second, Brad, all those expense accounts and revenue accounts, what we do is we take them and we put all the information, we close out all these individual accounts, and we put that information into one equity account called what? Retained earnings, right? So what happens is we close out all of the income statement type of accounts, we zero them out as of year end, and the net balance, in this case the $12,000 from year one, becomes net income. Subtract out dividends, and then the balance becomes retained earnings. So, Kelsey, that was a great question, and something we were going to talk about that I'm sure confuses the heck out of you at the moment, right? And so it's this whole process of closing out all the income statement accounts, and the reason we close it out is very simple. Why? No, because the income statement shows a flow. In order for it to be accurate, it has to have a 0 beginning balance, which means we have to close it out at the end of last year, and we close all those accounts out into an account on the balance sheet called retained earnings. So, great question. Some really bad drawing, right? But a great question. So, I'm hoping that you can do most of these journal entries, but I'd like to do journal entry number 10. And then we'll let you get out, and then we'll just review what went on and we'll get out of here. But journal entry number 10 is something we haven't yet seen. Okay, so we need to do number 10 before we leave today. So, who wants number 10? What's your name?
My name's Ray.
Ray? Okay, Ray.
Declare and pay dividends for $3,000.
Right.
You would credit assets for $3,000.
What's that asset called?
Cash.
Cash. We credit or decrease an asset, cash, for $3,000. Right?
All right. And you would debit equity for $3,000.
Debit, decrease in equity account, a retained earnings type account, called what?
Dividend expense.
Dividend. Now, what you called it is a very good guess. Turns out it's not exactly right. Because it turns out the dividends are not an expense on the income statement. And that's the tricky part about this particular. I mean, what you said was very logical, and the logic is right on the money. However, we have this funky thing about our tax system. And in our tax system, it turns out that if a firm pays dividends, they do not get a tax deduction for that. Which means that for accounting purposes, if a firm pays dividends, that's not an expense on the income statement. So because of our funky tax system, dividends, which is just like an expense, so the logic is exactly right, and it's a retained earnings account as if it were an expense, it turns out it's not an expense. It's not included on the income statement. And so we call it dividends declared. Same idea, everything else is the same, for $3,000. And this is a debit, here's a credit. Now, so after we did all of our transactions, right, let's go back again. what are we doing here? Let's go back and remember what the heck we're doing. We're recording transactions. So the accounting cycle is what? If you ever forget the accounting cycle, right? You're sitting there going, Bob, don't do it. Don't do it. Do this again. Well, I'm going to do it again. We have transactions. At the end of the year, we make adjustments, which we're not going to bother doing right now, right? Then we summarize. That's our spreadsheet. And then we create our financial statements. In this case, an income statement and a balance sheet. Everybody with us? So what I want to do is I want to go from here, and I want to go to our year 2. Let's go to the summary page, the spreadsheet page. So I'm on page 20. Oh, come on, Renee, can't you read? My writing is miserable when it's early in the day. So, on page 20, looking at the assets. And Brad, if you bring up the screen here, please. The thing you want to keep in mind is that for all of our asset accounts, different from the first year, we have a beginning balance from which we add or subtract everything that went on during the year. So for the cash account, we started out with $43,700, and then we paid some stuff, some cash came in, we paid some more cash came in, balance at the end of year 1, at the end of year 2 rather, $48,800. So we had a net increase in cash. Accounts receivable, net change went down by 1 from 5,000 down to 4,000, right? 5,000 beginning balance, 4,000 ending balance, based on what transpired during the year. Questions about that? Does that make sense to everybody? Okay. The liability and equity side. Accounts payable started out at 7, ended up at 7. Certainly reasonable. At the end of the second year, we did not record any payable to our employees, the wages payable. Common stock stayed the same. In the second year, we had retained earnings of beginning balance of 12. We had revenues, less all these expenses, but we also had this dividends that went on during the year, right? And dividends, again, the key thing here is dividends are not an expense on the income statement. So we're going to go next, and we're going to see the income statement and balance sheet, and you have to keep in mind dividends are not an expense. So the next page. Notice assets equal liabilities plus equity. Right? Remember, on every balance sheet, assets equal liabilities plus equity. You have to force that thing to balance. Right? In this case, 85,350. Again, notice the way the balance sheet is organized. We have total current assets. The assets are in order of liquidity, coming down to total current assets. Then equipment net. Now, why is it 20,000? What was depreciation expense in the second year? 2,500. So 2,500 first, then second year, 5,000 total. 25 minus 5 gives us 20 after the end of 2 years, right? Liabilities and equity. Accounts payable, wages payable, total current liabilities, total 7. Oh dear. Oh dear, that's not right. That should be 0. Okay, well I have something to correct on my computer. Wages payable should be 0. Total 85,350. Last thing for today: the balance sheet and retained earnings. Excuse me, the income statement and retained earnings. In this case, sales for the first year, 73, less cost of goods sold, second year, less cost of goods sold, 36, gives us gross profit, 37, subtract all our expenses, gives us net income of 9,350. Now, what is retained earnings at the end of the year? So if you go to the T account at the bottom of the page, or look at the screen, we had net income for the year, $9,350. We add that to our beginning balance of retained earnings, $12,000. Subtract out dividends for the year, $3,000, giving us our ending balance of $18,350. We go back to our spreadsheet, make sure that's what we came out to on our spreadsheet. $18,350, the amount on retained earnings. Questions about that? Had enough accounting for today? Okay. Next class, chapters 2 and 3. But remember, I'm going to assume you know how to do debits and credits when we come into class next time. So you need to practice a little bit between this class and next class. You have 2 weeks. Do some of the problems in the book. Questions?
I have a question about when all these statements are done. When you do the transactions, did you affirm to do them on a daily basis?
Certainly.
Okay, and then the adjustment, you do it at the end of the month? They do the adjustment
Well,
at the end of the month?
it depends. If they make a quarterly statement, they would do the adjustments at the end of the quarter. But they certainly make annual statements, and so they go back and review all the adjustments at the end of the year.
So I mean, if you have a lot of transactions going on, I mean, this is simple, but
It's complicated.
how about this spreadsheet? Is that an ongoing thing as well?
Let's cut it off right here. I'll answer this question. Okay. See you in 2 weeks. Thank you very much.